So, yeah. So this is your topic 3, and topic 3. I must inform you that this is about the corporate risk management, and I'm planning to do this topic in 2 parts. So it will be corporate risk management part 1 and part 2. And may I remind you very clearly and very loudly and in all my senses that this topic is the fundamental foundation basis of your second task. I don't know how to say it more clearly, but this topic 3 and topic 4 to follow would be the fundamentals, the foundation of your task second. And we only have 2 tasks. So the topic objective, it's very important to discuss with you. In task 1, at the end of your presentation, most of you showed me the SWOT, either explicitly in the slides or implicitly through your conclusions. And you said that these are the major risks which company is exposed to. Some of you said that the company's immediate cash is fine, their liquidity problem, it doesn't exist. But the problem is that the long-term financing could be a big issue. Or it could be a problem that the company has lots of debt, which the company is not going to pay right now, but the company would be paying in the next couple of years, and then it could be a big financial strain. Or some of you said that, hey, there is a problem right now, but it's a positive problem because there's less cash with the company, but don't worry. The company have done lots of investments. So that is why the bank balance of the company is low, but in the future, the company's investment will generate money. So that would be a positive side. So most of you mention at the end of your presentations that which are the major challenges. Now the thing is, if you leave a challenge unaddressed, it can become a threat, right? The difference between strength and weakness on the one side and opportunities and threat on the other side is that what you have is a strength and weakness. Your job should be to harness your strength into opportunity and try to get rid of your weakness so that it doesn't become a threat in the future. Like any other financial analyst, we never play our trumpets on the upside risk. So we will not worry too much about our strengths. Of course, we will try to make them the opportunities into strengths. But I would be more concerned about our weaknesses before they become threat. Task 2 is exactly that. What can we do that the weaknesses which we identified in task 1 do not turn out to be threats? In this task, in this topic, or the topic to follow, we shall be addressing the problem that how we can do the, what is it called? This crisis management. So there's a crisis, there are some weaknesses. Can we do something that this risk is nipped in the evil is nipped in the bud? It doesn't become a real thing. So that is the main purpose of this. And to do this thing, the first task, why I'm spending so much time on these things, because I want to clarify it. In the first task, we were diagnosing the patient. So you diagnosed that the company has not a solvency problem, but the liquidity problem. The company have liquidity, solvency is fine. The company's operations are very poor. So you were diagnosing, like we diagnose a patient. So you diagnose the financial health of the company. In this task, task 2, and the related topics, we shall give treatment to the company so that the challenge doesn't become a threat. And to do this, the one common medicine, like paracetamol, if nothing works, it works. We will be using the financial derivatives. So in this, the main common medicine, which everybody would be having, which you will give to the company, is the financial derivatives, is the main medicine which we shall use. And then we shall also use how the financial institutions can help you, how the banks, insurance, hedge funds, how they can help you to invest in the derivatives. So in this case, the financial institution is like pharmacy. I'm trying to keep it simple, that there's a patient. Doctor diagnoses the patient's problems. That's task one. And then we identified the problem. Now we want the treatment, and the doctor is giving you a prescription. And this prescription, you go to apteki, the pharmacy, and that's in this, if I use in the same language, in this case, our pharmacy would be the financial intermediaries, okay? And then at the end, you will be observing the patient, that's the company, and make a risk management policy of the company, which you will be writing in the Word file, and you'll be making a presentation of that. Now, based on the company's challenges, what type of risk management policy you have prepared. If you have prepared it, please share with us in the form of presentation. And the good news is that there is nothing much to calculate for task 2. It's more like a description. It's more like a discussion. Okay, so there will not be too much of relevance of spreadsheet. Well, you'll be using it, but not too much. You don't have to take last 5 years data. One year's annual report is enough. And may I specify that all these things which I'm telling you are there in Optima. Start here. There are 2 PDF files. One is the course description, and the second is particularly assignments description. If you read the assignments description document and go to task 2, you will exactly find out how many years annual reports you need to study. For the first task, it was 5 years, I guess. But for this task, this number 2, I don't think you have to study several years. 1 year or maybe at the most 2 years for a comparison is enough. Okay, but please go through that document in the beginning, not 2 days before the presentation. After you made presentations, I noted down that what have been the major risks which you people have identified. The one common risk is the rising costs, that the company's cost is rising, and that is why the operating profit margin is going down, okay? The second is the falling revenue. The company is not able to sell more. The third common, very generic factor was that the debt is rising. The company's D to E ratio, debt to equity ratio, is going up. And as a result, there is not only pressure on the company's liabilities, but also you have to pay interest. So the finance cost is also going up. The fourth feature was that the company's cash cycle is getting bigger. I mean, it used to be 70 days, but now it's 100 days. It means that in the beginning, the company has to keep enough cash to run its next 70 days operations. But now you must have enough cash to finance your next 100 days operations. This is causing a lot of liquidity problem to the company. It's a strain. You have to arrange debt money from banks, and you have to pay interest. All right. So these were some problems we got it. But now I want you to do something right now. I want you to study these 4 major challenges or weaknesses in the light of exchange rate fluctuation. I make it simplified. Is it so that your cost is rising because you are importing your raw material from Canada and your company is in Finland and the Canadian dollar is getting more expensive to euro? That is why, even though you are importing the same amount of inputs from Canada, there's no two ships now, still one ship. You are importing from Canada, but the problem is that, and there's no increase in the price in the Canadian dollars. The ship of raw material was costing you 50 million Canadian dollars. It still costs you on the tag price of the input is still 50 million Canadian dollars. But the problem is that euro has lost value against Canadian dollar. So you end up paying more home currency. No increase in the amount of raw material. There is no increase in the dollar price, raw material, the CAD, the Canadian dollar. But the problem is that the Canadian dollars has increased in the value and euro have lost value. And as a result, for one Canadian dollar, you have to pay more price. I'll give you an example, then it becomes simple. I stick myself to rising cost. You are importing one ship load of raw material, yeah? It's a ship. And this ship was having some 10,000 tons of things. Some raw material, yeah? It's a nice drawing. Is it good? Who likes it? Who wants good grades? All right, thank you very much. Okay, there is a art called calligraphy. You know calligraphy? Okay. If you see my handwriting, once I got a compliment from a teacher, and he said, "Shab," he was smiling when he gave me this compliment. He said, "Shab, your handwriting is cacography." And the way he said, because I didn't know the meaning of this word, I felt so happy about it. I said, he must be very happy because had it been not good, he would have been very angry, you know. But he said, "Shab, look at the cacography." And then I found this word. It was exactly opposite to calligraphy. So anyways, coming back to accounting. So 10,000 tons. And this you get from, sorry, have I forgotten the mast? You know, okay, let's leave it for some other time. And you are paying, the tag price is 300 Canadian dollars. All right. So remember, I'm linking it to your weaknesses of the company, but with the help of, I want to explain it with the help of the foreign exchange price fluctuations, so that you not only understand this accounting diagnostic and the health, the treatment, but also dynamics of financial movements, how the foreign exchange market works. So I want to kill many birds with one stone. Well, I don't want to kill, but I want to, it's just expression. So in terms of Canadian dollars, your import bill to finance your raw material should be how much? Well, you multiply 300. 1, 2, 3, 4 more zeros. 1, 2, 3, 4. How much it is? 1, 2, 3, 4, 5, 6. Yeah, is 3 million? 3 million. Okay. So it's 3 million Canadian dollars. Yeah. Now imagine when you were buying it last year, the Canadian dollar was equal to, because after all, your company is in Finland. So all the calculation you will be doing in euro, yeah? So the tag price was 3 million Canadian dollars, but 1 Canadian dollar was available for 70 European cents. It means that if you convert this to euros in the domestic currency, it would have been 2.1 million euros, yeah? Is it fine? It's simple arithmetic. Now, what has happened in comparison to last year, that your ship is still having the same amount, nothing has changed. The tag price of the Canadian supplier is still, he's saying that, please don't blame me, I'm still charging you the same price per ton. But what has happened? There's a macroeconomic change. And that change is that the dollar has become expensive, right? So I would say that now CAD is not for 70 cents, it's for 90 European cents. And if all remains equal, what happens? Your import bill has risen to 2.7 million euros. And then you see your consolidated financial statements. In the income statement, you find that the operating expenses have increased by 600,000 euros. On the surface, in terms of contents, in terms of substance, in terms of reality, nothing has changed. You still have 10,000 tons. And the Canadian dollar the Canadian supplier is not charging anything. He didn't say that he would charge now 400 Canadian dollars. He said, I'm still charging 300. But there is a macroeconomic change. The macroeconomic change is that dollar has appreciated or euro has depreciated. Now I'm using these two phrases, which you must remember. We don't say that Canadian dollar has become expensive. We can say in the common parlance, but basically it means that the price of the Canadian dollars in domestic currency has gone up. It means the Canadian dollar has appreciated. And if the foreign currency has appreciated, it means that the domestic currency has depreciated. Does it make sense? Is it fine? So this is a cause. This could be one cause of rising cost, which you will be discovering. Make sense? Okay. Who has not understood this arithmetic? So that I can explain it again to you. Say again? Yeah, I can. Alan, all I said is that, let's imagine that in task 1, you concluded that my company's threat, not a threat, but a challenge, is that the cost is rising, all right? And let's imagine, here I become a little bit I'm improvising, that let's say that the cost is rising because you are importing something. And you are importing from Canada. Your company is in Finland. It means your base currency is euro, yeah? But the inputs, those strategic inputs which you use in your factory are coming from Canada. And nothing on the surface changes. There's no change in demand. All is fine. You are still importing 10,000 tons as you were buying last year. But last year, the price of 1 ton was 300 Canadian dollars, right? Which still is, even this year, the tag price, the label price is 300 Canadian dollars per ton. But the problem is that, the problem is not with the Canadian dollar. The problem is with the euro. That euro has lost value this year. Last year, you just have to pay 70 cents to get 1 Canadian dollar. Now, the price, the euro has lost value. Let's imagine against Canadian dollar. and it went, now you have to pay 90 cents to get 1 Canadian dollar. It means that your import bill in domestic currency used to be 2.1 million euros, which has gone up to 2.7 million. Now, if you compare 2.7 and 2.1, you will find that there is a nearly 33% increase in the cost. If you compare 2.1 million euros and 2.7 million euros, there is approximately 33% increase in the cost. Nothing on the surface has changed. You still import the same amount, same price tag, but when you pay out of your pocket, you end up paying 33% more than last year, which is enough to disturb your budget. That's my point. And we have a intruder outside who's distracting me without feeling any, any guilt. So now what you do now, just the way you explained to me, or I explained to you, sorry, that how the foreign exchange fluctuation can cause you, push your cost up. Can you please find out how your revenue can fall in comparison to last year because of the foreign exchange fluctuation? I cook up an example of Canadian dollar. Maybe you were buying from Canada, right? Can you find some example so that you can explain with the help of an example about foreign exchange fluctuation, which can push your revenue down?
Could this work in reverse? Say, for example, if
No. If see what here I'm explaining, I'm translating the price of 1 Canadian dollar in euro, yeah? If I just do the reverse, then it will be 1 divided by 0.70, 1.43 something. Can you see it or not? I can try again. Because these things are very important to know right now. So I said that last year, Canadian dollar 1 was this. This is last year times 0 times 1. Canadian dollar 1 is 90. Yeah. So you said that now we have to pay more money in the local currency, which is euro. So it means the Canadian dollar has become expensive, hence appreciated. Now I want to use the same example to show that euro has depreciated. How? If I just reverse, if I bring euro here and Canadian dollar here, yeah, and 1 divided by 0.70, it becomes 1.43. So if you are in Canada, if you want to buy 1 euro, you used to pay 1.43 Canadian dollars. But now what happened? Now you pay only 1.11. So earlier, last year, now in Europe, you pay more euros to get 1 CAD. But if you are in Canada, now you pay less CAD to get 1 euro. It means what? The price of euro has gone down, hence euro has depreciated. So these two things happen simultaneously. When one currency appreciates, the corresponding depreciates. When you say this and this, you say CAD has appreciated. But when you say this and this, you say euro has depreciated. Make sense? So it's very important that these small arithmetic can get you good ideas. Now I come back to my previous question, that Just like in this example, your costs are rising in the foreign exchange transactions. Please find some example which highlight that your revenue is falling than before through the foreign exchange fluctuations. That's my point. So last year, for every $1 you earn, you were getting 1.10 domestic currency unit. But the thing is that now $1 is equal to euro 90. It means you pay less euros to get $1. It means what? It means Australian dollar has depreciated. And as a result, what happened? Even though in Australian dollar, nothing changes. In terms of Australian dollars, nothing change. They don't buy less from you. They don't pay you less. They still buy 8,000 tons from you. They still pay you 500 Australian dollar per ton. But the problem is with the euro against Australian dollar. Australian dollar is now become cheaper, means depreciated. If Australian dollar depreciated, it means that euro has appreciated. And as a result, in time one, you are earning this multiplied by this. Your export earning is no longer 4.4 million euros. It has dropped to 3.6 million euros. It used to be 4.4 and it's now 3.6. So I would say it's almost how much? Nearly 2% decrease in the revenue. Even though if you see the economic realities, nothing have changed. Still same ship, same quantity, same price. But because in the financial world, things have gone unfavorable to you, your economic reality remains same, but the financial reality have gone adverse. Okay? So your revenue has shrunk. So what lesson we learn? If the currency of importing, nation who we import from appreciates, and the currency of the country who we export depreciate, it's double whammy. It's like getting sandwich from the two, it's two bad evils striking together. All right. So see the situation. If the country who you import from appreciate the currency, yeah, and the currency to the country who you export to depreciates, what can be worse than this? So even though the economic realities, nothing change, but the financial realities can make you in a very bad shape. So what happens if I write down here, T0, T1, and in euros, your cost was no, not this one, the previous one. Your cost used to be 2.1 million euros. 2.1 million euros, which rose to 2.7 million euros. And the revenue, which used to be 4.4 million euros, is reduced to 3.6 million euros. So your rising cost, falling revenue. Good finance, bad finance? This is a question to you. Is it bad finance? The financial world has acted against you. All right. Well, the ideal scenario would have been that the currency, the importing currency depreciates and the exporting currency appreciates. So the Canadian dollar should have depreciated and Australian dollar should have appreciated. But my question to you, I can only pray to, well, I pray to some almighty that this happens. But if I'm a multinational company, billions of worth of assets, should I remain myself at the mercy of the fluctuations? Or should I be reactive or proactive? Should I do something? Should I wait till it happens? Or should I do something proactively that I can avoid this situation in the first place? What should I do? Proactive. This proactiveness we shall study with the help of financial derivatives, which is a very nice medicine, very dangerous. If it is an overdose, it can kill the patient. But if taken in a nice, mild quantity as and when required, it can be very useful. All right. When this quantity was taken, when the overdose was taken, you know what happened? Do you know what happened when this overdose was taken? 2007 crisis happened. So one major factor of 2007 crisis was overdose of this medicine called financial derivatives. So we shall try our best that in course I explain you that how should we take this medicine in a nice proportionate way. Yeah, make sense? So this is a situation, if we remain ourselves, if we always remain in a state of nirvana, moksha, and we ask, all right, no problem, whatever happened is a destiny. Let's accept it with a smile. No, I'm sorry, financial world doesn't run like this, and you have no right to do like this because the money is not yours. The money belongs to shareholders. They don't want to see your reactions. They want to see your proactiveness. And among other things, you can show your proactiveness is through the financial risk management. So please remember, financial risk management is our main objective in this task. But the main medicine or the main treatment that we shall use to achieve this target is called financial derivative. All right, so this is the background of this topic. So same way, rising debt, if you are borrowing from UK, for example, you borrow from them and the price of pound goes up. Guess what? You have to pay them more euros when you repay the debt. Or if the interest goes up, again, you have to pay the interest payment. So all these possibilities. But the bottom line is that avoid a situation in which the currency through which you will have a cash outflow appreciates and the currency through which you will have the cash inflows depreciate. This should not have happened. Okay? So, yeah. So we want to avoid this situation proactively so that in the time zero, the thing don't happen like this so that we don't face this situation.